So touching on the first sort of key theme around pre-transaction consideration. So, some of you joining the call, you may be part of an existing equity plan. You may also not have an existing equity plan. So there are various different considerations around that prior to a transaction. So, for example, if you do have an equity plan in place, one of the key things that we always encourage management teams to do is look at, do you have any unallocated shares or any unallocated sweet equity shares? Now, the reason why that's important is because you want to make sure you allocate that a long time prior to a future exit to make sure that you can allocate it and ultimately it is deemed a share and subject to capital gains tax. If you do allocate it too late in the day or it's too close to the exit or transaction, then ultimately that value can be delivered to whoever you want to incentivize, but usually that will be subject to income tax. So if you've got anything unallocated, you should have a think about it in terms of should you be allocating those out to existing shareholders or new participants to the scheme, just so that you're not losing any tax leakage. What the management processes look like. So the other thing is a little bit of pre-education prior to a transaction to make sure individuals are aware of what is expected of them during a transaction process. So it may be the first time you're part of an equity plan, and actually, what are the expectations of you if you're going into a process, and is there going to be a reinvestment expectation? What does that look like? What will you be reinvested into next time round? And having that full story to hand is helpful because it kind of sets a scene for anyone who's being asked to reinvest during the process. The last thing you want to happen is that to be a surprise, and actually at the sort of 11th hour of a deal, someone says no, or I'm not quite sure what's happening, don't understand, not willing to sign. So the more sort of educated everyone is and up to speed everyone is, the better. And then the other last bullet point there is any issues with your current equity plan. So that's another thing that we try to flush out quite early, is actually you should have a think about your existing equity plan and what are the pain points along that journey, because no equity plan is perfect until you've sort of been through that journey. So common themes here might be you might have issues with lever provisions, for example. So if you've had people be able to retain the equity, that might be something that wasn't particularly palatable to the senior exec team, of having levers retain equity, for example. The other sort of things to think about here are whether actually the equity plan that you have already in place is driving the right incentives. You may have a ratchet in there, for example, or some sort of performance metric which is or is not being hit. So things to think about there ahead of a transaction process. For those of you who don't have an equity plan in place, firstly, I suppose you should think whether actually the business is well suited to have an equity plan in place, and that's something that you'd like to look into. But otherwise, if you are going to a transaction process and you're being acquired, who are you being acquired by? What does that transaction look like? Is it private equity, for example, and therefore is there a reinvestment requirement expected of you? In that scenario, there's probably a discussion around how do you get proceeds to the management team in order for you to have some sort of reinvestment. Now, that may come in the form of an exit bonus consideration that you might want to discuss with your existing shareholder. But otherwise, you can also talk to various different loan structures that can be put in place from the buy side at the time. So if you don't have the benefit of proceeds to reinvest or exit bonus considerations, then you may be in discussions with having a loan mechanic in place with a buyer to help you buy into equity going forward. And then all the other sort of components of who should be investing going forward, who is the team now, who is the team going to look like next time round over the next 5 years, because that is where you most likely consider allocating the equity going forward. Now, just before we sort of dive into some stats and everything, a quick overview. So I've talked to sort of private equity incentive schemes. Some of you may be familiar, some of you may not be familiar. But here, what I've set out is 2 bar charts. One on the left-hand side is on entry, so at the investment point, and then you've got a theoretical exit scenario to the right-hand side, signaling sort of a 3 to 5 year exit and what the growth across the various different instruments might look like. So on entry, private equity would normally buy the business with some sort of third-party bank debt. So that's a blue bar there. And most of their capital, most of the equity funding from themselves, as well as management's equity funding, i.e. your rollover reinvested proceeds, would go into a combination of ordinary shares and fixed return instruments. Now, fixed return instruments might be preference shares or loan notes. Either or, the fixed return instruments will usually have a fixed interest return, hence fixed return instruments, right? So that might look like a 10% interest rate that compounds over time. So you'll see that the fixed return instruments from left to right, you'll see that grow by a fixed amount. So if it's 10% over 5 years, it's going to be 1.6 times, right, in terms of the growth factor on your fixed return instruments. On entry, so most of the capital is invested in fixed return instruments, some of it's invested in ordinary shares. Now, ordinary shares are differentiated between different share classes. Usually that will be A shares for the investor class of shares, B shares for the management investment class of shares, and then you've got C shares for, let's say, sweet equity shares. And that, in theory, on a future exit, that all grows as the business grows. And then once you've paid off the third-party bank debt to the right-hand side, you've paid off the fixed return instruments, which is the sort of compounded fixed return aspect. Anything over and above that flows to the ordinary shareholders, to which the idea there is that you will be part of the ordinary shares and the fixed return instruments. So if you have reinvested, normally you'll be co-invested alongside the investor in what we call institutional strip. That institutional strip is a combination of institutional equity and the fixed return instruments. So you'll be invested in the same proportion of instruments as the investor there. So therefore, if the investor is looking to make 3 times return, for example, in 5 years' time, you would also make 3 times return on your invested capital there as well. Now that comes back to the perfect alignment of interests point that I mentioned earlier. So that's a critical fundamental part of any sort of MEP scheme. Now, in recognizing that the passive investor, the PE investor, they're passive investors and they're not there day-to-day running the business and delivering the plan, that is where management team have a carve-out of equity dedicated to them only. And this is what we call sweet equity. And a sweet equity gives you the additional equity upside over and above what the investor has in their institutional strip / what any manager investing has in terms of the institutional strip. So the sweet equity effectively juices up your returns because it gives you additional equity upside. And that's pretty key. And that's where management would make more than 3 times return in that scenario, in that example, because you've got the sweet equity kicker over and above the institutional strip, which is the co-investment piece alongside the investor. So that's a quick run through of the PE sort of capital structure and how a typical PE equity scheme would work. On an exit, how do you realize your return? So usually this is going to be some sort of valuation multiple based on EBITDA of the business. So that determines your enterprise value. Businesses are sold typically on a debt-free, cash-free basis. So you adjust for debt and cash in the business. And that is what would give you your shareholder value in line 4 to the right-hand side in the graph. So that's the shareholder value. Now, the important thing here is that fixed return instruments is ranking ahead of the ordinary shares. So in line 5, you'll see the fixed return instruments get paid off first. And if you have invested, you also take part in the fixed return instrument. So you get your priority return here alongside the investor. And then the ordinary shares, anything over and above repayment of the fixed return instruments goes to the ordinary shares, which again, you will take part in because you will have institutional equity as well as sweet equity. So that's line 6 there, where you see the sweet equity participants as well as the institutional equity participating as well. So that's how the sort of what we call the proceeds waterfall works in terms of the order of payments. You need to pay for your cash and debt gets adjusted out. Fixed return instruments get paid next, and then the balance goes to the ordinary shareholders, to which the sweet equity and the institutional equity shareholders take part. Who should be part of the equity plan? So this is very much personal to each and every management team and business out there. So it very much depends. And it's one of the things that we sit down and speak to management teams about. Usually what we see most commonly is that the equity is spread across the senior management team, which means the C-suite team. Now that's the way we tend to guide management teams, is that the equity should sit with the people who are driving the business plan and driving the equity growth, right? And it's important that whoever's doing that understands what they're holding, understands the power of the sort of the sweet equity that they're holding. Now, if you're, just for sake of to play devil's advocate, if you're allocating to a sort of junior, let's say graduate or the most junior entry point to the company, now the question is, will they understand an equity sort of share that they hold? Will they be there, long enough to sort of realise the growth in that equity and through to an exit, for example? So usually it's contained for the senior management team. Now, we speak to some management teams and they like to allocate out to the next tier down. So let's say the next 20 or so managers, because the nature of the business requires a lot of, let's say, a big sales force, right? So you might have a bunch of sales individuals sitting there who need to be incentivized for the business to grow. So that might be reason for you to extend the equity further down. And then we have some businesses which are very people focused. For example, we've advised a bunch of different accounting businesses, different wealth management practices, where actually everyone is involved in driving revenue, and therefore they want everyone to be involved in the equity scheme. So that's where a much wider scheme comes into play. So we've advised businesses which have 400 plus employees, all part of the equity scheme.